Good day, everyone. I go by the name of Luther, and I would like to welcome you guys back into my YouTube channel tutorial program where we inspire a students to achieve greatness through the mirror learning. So, without wasting any more of your time, let's get straight into today's video. So, today, I was still busy with our transactions. We were still busy with our transactions, our income statement transactions. So, I will just finish that up quickly, and then. Okay, so we're doing. What are we doing? Okay, so this is the question 3. So we'll be focusing on this question 3, which says Tito Traders provided the following information for the year ended 30 June 2020. So 30 June 2020, need to keep that in mind. 30 June. So it's 30 June. Okay. June, July, September. Okay, so we need to just include the May. Oh, here's a 30 June. Just. Oh, 30 June. June, January, June, July, August, September. So June 30. And this is the first day of the month. The last day of the month. The years 2020. June 2020. So it's 2020. So meaning it's 2019. 2019. Okay. Okay, so let's go. Okay. So we have all the information, our trial balance, and then we also be looking at our additional information. So additional information number 1 says inventory on hand. So this is going to form part of our closing inventory, the trading inventory. This is going to form part of our closing inventory, and then consumable stores. This is the consumable stores on hand, in which it will form part of our consumable stores. So we have our consumable stores, which is our total expenses for the consumable stores. So we're simply going to minus the on hand, this 396. We're going to minus it from our total consumable stores. And then number 2, they're saying write off M Mateo's account SE recoverable by 558. So as we all know, this is going to form part of our credit losses. So this is going to increase our credit losses. So we're going to say plus 558. And then number three, they're saying allowances for credit losses must be adjusted to 4% of trade receivables. So this is where it's going to get tricky. Okay, let's go. Okay, so doing allowance for credit losses. Okay, so we're doing transaction number 2, number 3. Yes, number 3. We're doing this allowances for credit losses must be adjusted at 4% of trade receivables. So we all know what we do. We say 4% multiplied by open bracket trade receivables. What's our trade receivables? Trade receivables. It's trade receivables it's 27. It's 2796 minus our credit losses, our recent credit loss, which is okay. Okay. Allowances for settlement, the Mateus account of irrecoverable. So we minus the 558. Close bracket. And then answer. So it's equals to 4% multiplied by open bracket 2796 minus 558 close bracket, and then you say enter. What? Just so it can't be this much. Okay, let me redo this just to confirm. 4%. Okay, let me just say 207 96 minus 558 equals to 220. You see, it equals to 4%. Multiplied by 20238. Enter. What? Is this correct? There's no way it's 80. Or is it 809? Let me just bring out my calculator, because I don't think this is correct. So you say 4% multiplied by 20238. So it's 809,52. Let me see this. Oh, fraction. It's supposed to be number. Okay, so that's why. Okay, so it's 809,52. So we know decimals. We don't want decimals, so it needs to be a whole number. So this answer of ours needs to be a whole number. So let's go back to the question. So the question said must do what? The question said allowance for credit loss must be adjusted. So we adjusting, we're not creating a new one. So we're adjusting. What are we adjusting from? So now going back to our trial balance. So our trial balance, they say allowances for credit losses. So we can see we have an allowance for credit losses. Let's see how much was it. It's what? It's 568. So before we had what? 565. Now we have what? This is before and after. So we had this before. So it's 565. So now, since our allowances for credit losses, it's going up. As you can see, we're coming from 500. Now we're going up to 810. So since we are going up, since our credit losses are increasing, our allowances for credit loss is increasing. It means we're taking more money, we're putting it aside. So this is going to form part of our expenses. The difference is going to form part of expense. So on your income statement, you're going to say you're going to have allowances for credit losses under our operating expenses, and then you say open bracket, and then you say 810 minus the 565 close bracket, and then your answer. The difference between these two amounts will be your answer, your total answer under your operating expenses. So I don't know if I make sense. So if this was going down from 565, and then maybe we had like 300 after we did all the calculation. So since it's going down, it means it was going to form part of our other income. So if it's going down, if our allowances for credit losses is going down, then it forms part of your other income. If it's going up, it forms part of your operating expenses. The difference between the two amounts, it's your answer. So I hope that made sense to everyone. Okay, so we can move on from that. I don't want to waste time. Okay, so number three saying allowance. Okay, no, what? Allowances for settlement granted must also be created at 3% of trade receivables. So when we're doing this one, they said what 3%? So we say 3% multiplied by, they said trade receivable. So multiplied by, open bracket, we need to say 2796 minus 558. We must also minus what? Our allowances for credit loss. We must also minus what? Our allowances for credit loss, which is our 810, and then close bracket. So close bracket, and then we say 3% multiplied by, let me get the answers first. I see what that's doing, which is 19428. So it's 19428. Okay, then we say 3% of 19428, and then we're going to have our answer as of 582. Then the decimals. So we're going to have our answer of 582. Let me just do this. So remember, it needs to be a whole number. Our answer needs to be a whole number. Okay, so moving on, what are we doing? So moving on, let's say take note. Okay, so now we are coming to our inventory. So let me just do this. So we're coming to our number 5. So number 5, they're saying inventory of 1614 was returned to our creditors. Okay, so I forgot to mention this. So this amount of 583, this amount of 583, we're going to have allowances for settlement discount. So we're going to have what we call an allowances for settlement discount. So they said it's our allowances for settlement discount. So it's number 4. We're doing number 4, right? So number 4, they said you must create an allowances for settlement discount granted. So we're going to write it as it is, allowance for settlement discount granted, under your other expenses. So this one is always under your expenses. So it always forms part of your expenses, and then must be created at 3% of what. So this is how you do the calculation. So this calculations here. This is how you do that discount, that allowances for settlement, discount granted. That's how you do that. So always remember that you need to minus what? You need to minus this amount you got from the 4% of allowances for credit losses. You need to minus it also. Isn't it? You said trade receivables minus our credit losses, and then you also minus what? The allowances for credit losses. Then that's when you're calculating your 3%. And your 3% is going to be what? 583. So you're going to, under your operating expenses, you're going to write that allowance for discount allowed, and then your total answer is going to be what? 583. So if you want, you can show your calculations in brackets if you want. I don't think you're going to get marks for that, but then you can still do that. And then now we're having our number 6. Number 6, they say depreciation must be provided as follows: on vehicle 15% per annum on diminishing balance, and then on equipment 23% per annum on cost. And then take note that the vehicle to the value of 3,600 was bought on 1 January 2020, and then a furniture of 840 was also bought. Okay, so this one, so the equipment is exactly the same as the one we were doing on the previous question paper. It's exactly the same. So the process is still the same. So you're going to say what? You're going to say for equipment. So I'm not going to do the whole calculation for equipment because it's going to be time consuming. So equipment, I'm only going to do for this diminishing balance method because it's something different. Okay, so what happened, Konjemo? So we have on equipment 23% per annum on cost. So what is the cost of the equipment? Cost of equipment is 25,260. So we're going to take that 25 to 60, I think, and then we multiply it by what? We minus the new equipment we bought, or is it? Yeah, the new equipment we bought, which is the 800, the new furniture actually, which is 840. And then you're going to get your answer. So that answer, that's what you're going to times it by 23%. And then after that, you're going to say, let me just do this quickly. So it's 25 to 60 minus 840. And then you get this, and then you say is equals to, is it 23%? Multiplied by 24420, and then you get your answer. So this is going to form part of our depreciation for the old equipment. This is the depreciation for the old equipment, and then for the new equipment, same process. We're going to use what? This 840 that we've minus there. We'll say 840 multiplied by 23%. Multiplied by the number of months in which it has been in the business. So it was bought on 1st January. So 1st January, we bought that. So we're going to count from January. So this is December, January, February, March, April, May, June. So our year ends June. So meaning 6 months. Multiplied by 6 over 12. And then your answer that you get, that's going to be your depreciation. That's going to be your depreciation for the new equipment. So that's how pretty much how you do that. And then now for this one on vehicle at diminishing balance method, and then we must also take into account that a new vehicle was bought. New vehicle has been bought. Okay, so let's do this quickly. So how are we going to do this one? So the way you handle this one, you're going to simply say what? The way we do this, we're going to simply say we're going to say the cost. What are we doing on the vehicle? Okay, so vehicle depreciation for vehicle. So we're going to say cost for vehicle, which is 176,400 minus. So we're firstly going to minus what? The new vehicle that we've bought, which is 3,600. To get what? So let's do 176,400 minus 3,600 to get this 172,800. So to get this 172,800, so this is the amount you're going to minus your, this is diminishing balance method. So diminishing balance method is what? Is cost minus accumulated depreciation. So this amount, this is what you're going to use to minus your accumulated. So we say 172,800 minus accumulated depreciation. What is our accumulated depreciation? Accumulated depreciation on vehicle, I think we're looking for on vehicle, which is the 62. So we need to minus 62,208. We minus the 62,208 to get what? So let's do copy. So let's do, then you can paste 172,800 minus 62208. Then we get our answer. So this answer, we're going to multiply it by the percentage, which is, so let's do 110,592 multiplied by what? Percentage. Multiplied by our percentage, which is 15% per annum on diminishing balance, which is 15%. And then say enter. So this is the amount we get. So guys, if this is confusing to you guys, as I speak, please write it down on paper so that you're able to see all the calculation as to how I did it and why am I doing this and this and this, so it can make proper sense to you guys. Because now, as I'm looking at it like this, it might be confusing to someone else. So hence why I'm saying, if you don't understand what's being happening here, just write it down as I speak so that it makes sense to you. So this amount is our, what is this, 15%. So this is the depreciation for old vehicle. So this is the depreciation for old vehicle, because we said 15% times the amount times this amount which is excluding our accumulated depreciation. That's how we do that. And then now we need to calculate depreciation for new vehicle. So new vehicle, same process that we've been doing. 3,600 multiply by 15%, multiplied by the number of months. So we was bought 1 January also. So 1 January until 1 June is what? 6/12. So that's how you do that. So that's going to give you your answer, and then this is going to be your depreciation for new vehicles. So you're going to add all the depreciation. You're going to add the amount you're going to get after you calculate this, plus this, plus what, Konje? Plus whatever you calculated here, which is, this is for depreciation for equipment. So whatever you calculated here, you're going to add all those in brackets. So in brackets, you're going to add all those to give you your total depreciation for equipment and vehicle. Okay, we're moving on from that. So we're already on 24 minutes. And I was hoping that this video won't be so long. So okay, but then let's push quickly. So guys, if any of the things I've been saying are confusing to you guys, just be sure to write down on paper as I speak, so that it makes proper sense. Okay, so we're moving on. We're doing number 7. Number 7, they're saying interest on fixed deposit must be adjusted. Our interest on what? On fixed deposit. So let's see. This one is straightforward. Interest on fixed deposit. Fixed deposit. We say going to our fixed deposit, you're going to see what's happening with our fixed deposit. So here's our fixed deposit at Tech Bank, 14% per annum. So we're simply going to say what? 14% multiplied by 105. 1, 2, 3. And then our answer will be 14% multiplied by 105. 1, 2, 3. Our answer will be 14,700. So we need to pay 14,700 for the period. The period we are currently on our fixed deposit. They need to give us what? So fixed deposit we are not paying, they are paying us instead. Fixed deposit, it's us as a business. We made an investment. So that investment, we're going to get what? Return on investment. So our return on investment for the year, it needs to be 14,700. So this is going to form part of your other income. Yes, this is going to form part of your other income. So this is the total amount. So let's see how much we've received so far. Let's see how much we have received so far, because they said we need to adjust. So our fixed deposit, here's our fixed deposit. Let's see how much we've already received so far. So fixed deposit, we've received 6,256. So in brackets, when doing our fixed deposit, we're going to have open brackets. So isn't it going to have interest on fixed deposit, and then open bracket. So open bracket, we're going to say what? We're going to write the amount on the trial balance. The amount we have on the trial balance, which is the 6,256. 6,256. And then we add it with what? We add it with the difference between the two. When we say 40,700 minus this amount, what are we going to get? Because this amount, this is going to form part of our total. This is our total amount we need to get for the year. So now when you're adjusting here, we're going to say this minus this to get the difference here, and then we close our bracket. So let me just see what is the difference. Let me just write the difference quickly. So it's equals to this minus 6,256, which is 844. So simply meaning we're going to add it with 8,444 to give us a total of 14,700. So this is how you're going to record it on your income statement. So this is how you record it on your income statement. So we're moving on from there. This was straightforward. Provide for the outstanding interest on loan. Outstanding interest on loan. So this loan also, you're going to follow the same steps that I did when doing the interest on fixed deposit, because you're going to check. They said it's 20% per annum. Total amount of loan, we've already done a similar transaction like this on the previous question paper I was doing. So just go back and rewatch that video, or you can do it exactly the same way as we did the fixed deposit, because we're going to say 20% of what? Of 120. 20%. Where do I get the 20%? They said we took a loan from Axis Bank, 20% per annum. So we're going to say 120 times 20%. Whatever the answer we get, that's going to be our total. And then we're going to write that under our financial costs. And then how much have we paid already? So interest on loan, we've already paid what? 6,000. What is the remaining amount? So let's say 120, 123 multiplied by 20%. So this is because I said 12,000, so it needs to be 20,000. 120,000. So this is the formula. So you're going to write it exactly as it is, and then when you say enter, you need to pay a total of 24,000 for the whole year. As you can see, we've already paid what? 6,000. So in brackets, you're going to say interest on loan, open bracket, 6,000, and then you're going to say plus the difference between these two amounts. You say this minus this, exactly as I've done here. So this amount is going to form part of your totals. It's going to form part of your totals. And then in brackets, you need to calculate what needs to happen in order for us to reach this amount. Simple, straightforward, simple ABC. So number 9, they're saying rates and taxes for June 2020 has not yet been paid. So June 2020, June is what? The last day, I think. Alright. Yes, June is the last day of the month. So rates and taxes, how much have we paid so far? So rates and taxes, we've paid 7,392. So we've already paid 7,392. So meaning this amount is for 11 months. So this is the amount for 11 months. So we're simply going to say that 7,392 divided by 11 to know how much are we paying every month. How much we are paying every month. So that amount that we're going to get, we're going to say 7,000. You can do this on your calculator as I speak. You're going to say this amount divided by 11. Whatever amount you get there, that's going to be your amount for the month. So now, as you see, they said only 1 month is missing. So meaning you're going to say this amount again plus the amount you got for the month. You're going to add it in order to get your total amount for the whole year. So that's how you're going to do that. Straightforward this one's straightforward. I don't want to waste time. And then number 10, the owner cashed a check of 5,775 for personal use. The interest has been made in the drawings, but no interest been made in the bank account. Okay, so this is our drawings, ne? So this is our drawing. So since the owner cashed a check, so the owner is cashing a check. So this is cash. So this transaction doesn't affect our income statement at all. This transaction is not affecting our statement at all, unless if they had said the owner took inventory. If they said owner took inventory, then this amount you are going to minus it from your purchases. But then now, since they cashed, they took money, they took cash. So this transaction, it doesn't affect our income statement. So that's pretty much that for this question paper. So let me see what's going on here. Okay, so number 1, they're talking about inventory, the account write-off. Okay, so now you know how to handle all this. So now you know how to handle all this. It's fine. And then for depreciation, now I'm sure you know how to handle all types of depreciation. Take into account that the vehicle with a gross carrying value of 150 was sold for cash for 90,000. Okay. Cumulative depreciation until the date of sale was okay. Interest received includes the amount of 3,000 which is applicable for the next financial period. Okay, so interest received. They're saying interest received. So they're talking about our interest on fixed deposit. So we receiving this interest on fixed deposit, 18,420. They said it includes what? It includes 3,000 which is applicable for the next financial period. So meaning we're going to say that amount. We say this amount minus the 3,000 to get your answer. Provide for the outstanding interest on loan. The loan was made on 1 March 2015. So this one straightforward. You're going to say interest on loan, provide for outstanding. Same process as doing this interest on loan. And then number 9, create provision for legal costs for 40,000 which will be payable in the next financial period. Create a provision for for legal costs. So the same, we need to create provision for legal costs, which will be payable in the next financial period. So since it's a provision, so this one also, you're going to create a provision. So under your other expenses, you're going to say provision for legal costs, provision for legal costs, and then the total amount is what? Is 40,000, which will be payable in the next financial period. So that's how you do that. That's how you do that from under your other expenses. This is where you're going to record that. And then the insurance includes a policy with an annual premium of 120,000, which is payable on 1 January every year. So insurance includes an annual premium of 120, which is payable on 1 January of every year. Okay, so this one is the same as the annual bonus. On the previous question paper, I was doing a question paper in which we had an annual bonus. I can't recall the annual bonus of what, but then the calculations is exactly the same, just different timelines. So if I am to give you a quick run up of what you need to do here, simple, straightforward, you need to, okay, so they say annual premium of 120, payable 1 January. So every year, what am I looking for? 1 January. Okay, so every year on January, we're paying what? 120. 1, 2, 3. So this 120 in this financial period, every year. So if this amount is paid every year, let me see. Insurance includes a policy with an annual premium of 120, which is payable on 1 January every year. So meaning this 120 we will be paying it on 1 January. So it will cover this remaining 6 months up until next year. So this is February, March, April, May, June. Yes, so this amount will cover all the way this remaining 6 months. So but then this total amount is for 12 months. So but then on our financial period, on our current financial period, we only having what? On our current financial period, we are only having 6 months left. So we're going to say this amount divided by 2. Reason being, we have 2 6 months in a year. So we have first 6 months and the second 6 months. So whatever amount you're going to get there, which is like 60,000, the 60,000 you're going to get, you are going to minus it from your total amount of insurance. So what is the total amount of insurance? So insurance. So we have this amount for insurance. We have 170,000. We have 170,000. So 170,000. So we're going to say insurance and an open bracket, which is 170, 1, 2, 3, minus 60,000, because that 60,000, that 60,000 that we are minusing, it belongs to the next financial period. That's the amount for the next financial period. We don't minus the entire 120 because the other 60,000 belongs in this financial period. So the other 60,000 will cover this remaining 6 months. The other 6,000 that we are taking out, it's for the next financial period. And then we're going to say this minus this to get the total answer of 110. So that's how you're going to do that. Okay, so moving on. Okay, so the reason why I'm doing it so quickly is because we're already on 40 minutes, guys. So I don't like it when you guys spend so much time watching this, because you guys are complaining. Okay, so this first 4, you know how to do them. you know how to. Oh, I wanted to say something. I wanted to say that we have this transaction number 6. Try to do this transaction number 6 on your own, and then you can tell me on the comment section as to how much you got. If you do it and then you do it correctly, you can tell. If you're confident, whoever is confident, you can tell me on the comment section as to say transaction number 6. Just write there, transaction number 6. I believe the total answer is this amount of money. So total answer being when you're adding the depreciation for vehicle and equipment, the total amount you're going to get this amount. And then I will look at that, and then I will let you know if you are correct or you are not, because this is nice. Okay, so now we are going to look at our rent. So we're going to do our rent on this. Interest on fixed deposit was for 2 months only. Calculate outstanding interest. Okay. Yeesh. Okay, so let's start with our rent. Rent has been received up to 31st December 2018. So the rent has been received up to 31st December 2018. So let's do our timeline quickly. So 28 February 2018. So this question paper is the 2019 question paper, 2019 June question paper. Timeline. So year end February 2018. So our year ends February. So this is May, April, June, July. Okay, so let me just February. February, March, April, May, June, July, August, September, October, November, December, January. February is the year end. So meaning we have January here. February is the year end. So meaning it starts on March. So we're going to have March up until February. Yes. January, February. 2018, I think 2018. So meaning the year begins on 2017. Okay. Just do this. Rent. So we're doing our rent. Rent income. What are they saying again? So they said rent has been received up to 31st December 2018. 31st December 2018. Oh yeah. 31st December 2018. So meaning we're still short of this last 2 months. An increase of 3% was implemented on February 2018. Okay, so since rent was received up to 31st December, so what we simply 31st December is what? 10 months. 10 months from March up until December, it's what? It's 10 months. So the received amount, how much did you receive? So rent income, we received 32,500. So this 32,500 is for what? Is for 10 months. So we received what? 32,500. So we're going to divide that amount by 10. So when you divide, let me say equals to 32,500 divided by 10. Divided by 10, what do we get? We get 3,250. So we are paying 3,250 every month. Every month. So this, as I've already said, the 32,500 is for until December. So let me just do this so that it makes sense to you guys. So it's 32,500. So we are remaining with what? We are short with these two amounts. We are short with these two amounts. So the amount for January. So what did they say? What did they say again? So as you can recall, if you can recall, they said rent has been received. An increase of 3% was implemented on 28 February 2018. So this increase was implemented on 28 February 2018. So since it's been implemented on 28 February, so it means the increase will only take part on the next financial period. So I thought this increase will affect our financial period, will affect our current period. But then now they said on the 28 being what? The last day. They implement it on the last day. So since they're implementing it on the last day of February, it means it will only start taking shape on 1 March 2018. 1 March is what? The next financial period. So meaning this transaction is simply straightforward. We're going to say this amount times 2 to know what is the amount. So isn't it we have 3,500 for these 10 months? So we're also going to have 3,200 for 3,250 for January, also for February 3,050, 250, just like that. And then you're going to add all these amounts in order to get your total rent income. So you're going to add everything to get your total rent income. So I hope that makes sense, you guys. I hope that makes sense. I thought this was going to be tricky, but then looks like it wasn't that much tricky. Okay, so we have provision, we have this, we already know how to do that. Interest on fixed deposit was for 2 months only. Calculate outstanding interest. So calculating outstanding interest on fixed deposit, so you're going to simply go to our interest on fixed deposit. They said it's 14% per annum, so you're going to say this amount times 14%, and then you get your total amount for the year that you need to pay for interest on loan. And then on brackets, you're going to have this interest on fixed deposit, which is this 400. And you're going to say interest on fixed deposit when you're doing your income statement, open brackets, and then you say 438 plus the difference between what you got minus this amount. I hope that makes sense. It's the same as the one I've been doing with the interest on fixed. It's the same as this interest on fixed deposit. Okay, next. Provide for the outstanding interest on loan a payment of 3,125 was made towards the repayment of the loan on 30 November. Okay, so I think this is going to be our last transaction, guys. Oh, I will also do this transaction also, and then I will close it because it's been too long now. Premium of 900. So this one, we know it. I will also do this interest on fixed deposit is due. I will also do this transaction, I think, because I think this is one of the tricky transactions to do. Okay, so let me do this quickly. This interest on loan. So our interest on loan, so rent, we done it that. So now we are doing our rent income. Okay, not rent, interest on loan. Interest on loan. What's happening, Konji? Okay. Let me just. So provide for the outstanding interest on loan. repayment of 3,125 was made towards the loan on 30 November 2017. Okay. Ish. Okay, our interest on loan. Okay. I'm sorry, guys. Interest on loan, no repayment. Okay, so our interest on loan. How much did we borrow? So we borrowed 25,000 at a rate of 20% per annum. And then we made a repayment on the loan of 3,000 when 30 November 2017. So meaning on the last day of November. So meaning it will start being implemented here. So meaning that so what's going to happen here now? We're going to calculate the interest until November. So the interest we'll be calculating for until November, we'll be using 20% multiplied by 25,000. We borrowed 25,000, isn't it? Multiplied by 25,000. So the answer, we're going to get an answer here, which will be equal to something. I don't know, your calculators. You're going to get an answer. And we're going to say 20% times 25% times the number of months. I forgot the number of months. So we're going to say 1. So it's 9 months because there's 3 months remaining. So times times 9 over 12. And then you are going to get your answer. The answer you get there, that will be your interest on loan for these months. And then now we need to calculate interest on loan for the remaining months. The way we're going to do that, same thing. We're going to say 20% multiplied by, now we're no longer multiplying it by 25,000. We're no longer multiplying by 25,000 because we paid what? We paid the 3,000 already. So when we say 25, 1, 2, 3, minus the amount we've already paid. The amount we've already paid, which is 3,125. So 3,125. So this amount, we're going to minus it because we already paid that on September, 3,125. And then when you minus that, you're going to get 21,875. So here, for the remaining 3 months, you'll be saying 20% times 21,875 times the number of months. Number of months again, 3 over 12. And then you're going to get your answer. The answers you get here, you're going to add this plus this to get your total. You're going to add the 2 x's. The number you're going to get here on your x's, you're going to add it together with this amount to get your total amount of interest on loan. That will be your total amount. And then in brackets, you're going to find out what's going to happen in brackets. You're going to have to find out what's going to happen in brackets. So in brackets, simply what you're going to do, you're going to take the amount on the trial balance, which is your interest on loan. You're going to take this 1,875, and then you're going to add something so that you can get the total amount you got when you added this plus this. The difference, when you say this plus this, you're going to get an answer. So let's say, for example, that answer is 10,000. If you get 10,000, when you say add this plus this, you get 10,000. So it simply means you're going to say that 10,000 minus this 1.875. You're going to minus that, and then the difference you get, that's what you're going to say. You're going to say 1.875, I think. plus the difference you get when you say 10,000 minus that 1,875, close bracket, your answer. Simple, straightforward, simple ABC, simple ABC. So we're moving on. I hope this made sense. Guys. I hope this made sense, you guys. So the reason why I'm doing this so quickly is because I see that we've almost on an hour doing this. What am I looking for, Konye? Oh, that's almost on an hour doing this. Okay, moving on. Okay, so we're doing our last transaction. We're doing our last transaction on this question paper, which is this transaction. Rent has been received up to 30 April. This amount has already been entered in our books according to the contract signed by the tenant. The monthly rent will increase by on 1 June by 10%. Okay, so you guys, it's up to you guys to do this transaction. It's up to you guys to do this. If you're confident with your answer, you can also on the comment section let me know what you got for rent. So just simply say rent. Total answer is this, and I'll let you know if you're correct or you're not. And then interest on fixed deposit is still due. An amount of 9,375 was invested at Mutual Bank on 1 March 2017. 1 March. Where is 1 March? 1 March. Oh no, 1 March 2017. So meaning at the beginning of our financial period. Ah man, this is another question paper. I forgot. Okay, so going back to our question paper, let's see. We have a new what do we call this? Timeline. These timelines. So it's June 2018. So June 2018, July. You say July, August, September, October, November, December, January, February, March, April, May, June 2018. June 2018 ends. June 2018 it ends. July 2017 it starts. So how do we do this? How do we go about this? What am I looking for, Konje? So this one is going to be exactly the same way as we've been doing that rent. Not the rent, the interest on loan. The previous interest on loan that we've done. So as you can see, interest on fixed deposit is still due. The amount of 900 was invested on 1 March. So 1 March, who is our 1 March? 1 March. So this is 1 March 2018. So this is March 2018. December 2017. 1 March what? So they said was invested on Mutual Bank on 1 March 2017. So since they're saying 1 March 2017, it means, so I'm assuming they made a mistake here, guys. So I think they meant to say 1 March 2018. So meaning we invested here. Because if they said 1 March 2017, it means they invested it even before on the previous period, on the previous financial period. That's where they invested their money. So if it's like that, we're simply going to say we are going to do it exactly the same way as to say interest on loan. I'm sorry. Interest on fixed deposit. We're going to say 9% multiplied by this amount, and we get our answer. Simple as that. We say this multiplied by this, and then you get the answer you get. That's your final answer. But then now, I think they made a mistake here to say 2017 is supposed to be 2018. 1 March 2018. So let's treat it as 1 March 2018. So since we invested 930 what at Mutual Bank on 1 2017, so is this a post or pre-adjusted? Okay. So the way we're going to do this, it's 1 hour. Yes. Okay, let me do this quickly. So I'm sorry if I'm going up and down like this. Some of these things you don't have to be too fast on it on one match. So meaning from here, so here you can see that, and then this. Okay, so we have something like this. So when we're calculating, going back to our calculations, so 37,000. So our total investment is what? 37,500. So in this 37,500, we have that amount of 9,000 something that we've invested on 1 March 2018. That amount is also included in this amount. It is also included because we are dealing with a pre-adjusted trial balance. So since it is included, firstly, what we're going to do, what? We're going to say 37,500 minus that amount that we've invested during the course. Okay. You can simply do it like this. Okay, it's 9,375. So it's 9,375, and then you will get your equals to 7,500 minus 9,375 to get your 28. So this 28 is for before we invested this additional amount. So we're going to say 28 what? 125 multiplied by percentage. Percentage is what? 9%. Multiplied by 9%, yeah. Multiplied by 9%. Multiplied by, are we supposed to multiply by the number of months? We can do it that way. We can say multiplied by the total number of months, which is what, Kanje? 1, 2, 3, 4, 5, 6, 7, 8. 8 months. 8 over 12. And then we are going to get your answer. And then you also come here, we say 37,500 multiplied by 9% multiplied by how many months? 4 months. 4 over 12. So you can do it like this, and then you're going to get your answer. So if I'm not mistaken, you can do it like this. And then the answers you get here, you're going to add the two answers to get your total interest on fixed deposit. Or another way of doing it. So this is how the first way of doing it. You will check if the answers you get are the same. But I'm pretty sure that you're going to get the same answer. So you can say here, instead of adding these months, you can simply say, you can just leave it as this, 28 what times 9% to get your answer. So after you get your answer, so you don't times any months, you don't include any months. So after you get your answer, and then here, I think what you can do, you can say 9,375, and then times 9% times 4 over 12. So this one you do include the months, because this amount we've invested it for a period of 4 months. So I think you can do it like this. Okay, so just do these two methods and then just check if you'll be getting the same answer, which I'm pretty sure that you will get the same answer. So I think that's all from me. So thank you guys for tuning in. If there's anything that you might have missed, just rewind the video and rewatch again. If there's anything I didn't explain proper, just let me know in the comment sections, and then I'll be sure to do better on the next video. So from me to you guys, this is all. Have a lovely night, guys. Bye.